This is a mind-blowing number because it's both China and US put together. Uh, the per capita consumption of every single Indian is 37 GB per month, which is like roughly watching probably what, two Hindi movies a day, literally. Right? Slightly more probably. But the fact is that that's the kind of data we consume. October was the first month when we bought Reliance in that particular month because in their AGM they announced that they're gonna de-emerge the telecom business.
When I look at the holdings of the Flexi Cap fund today, what does it tell me, the investor, about how Helios is thinking about the market as a whole?
And we said, look, we can't be this straitjacketed. We have to be more aggressive in our Flexi Cap. And you've seen that, right? In our case, we've gone as low as, I think, 47% in the large cap space and as high as probably 70 odd percent in the large cap space. So, and by the way, the timing has been perfect. I mean, if you had looked at our portfolio sometime in October, it was 70% large caps, right? Of last year, I'm talking. And today, it was 46% in September end, and I think October end was close to 50. So that's how it has been. So we've been very flexible in our approach. Our stance of staying away from PSUs is not because of anything else, but the fact that they're not consumer-facing banks. They're more of CapEx-related banks, right? I mean, they partake in infra spends and stuff like that. Yeah. Our call on BFSI has been purely that consumption will pick up. And obviously, you need to get into the space where you believe is going to aid this consumption. So obviously, the NBFCs and the financial services and the wealth managers or the gatekeepers to wealth, if you call them, the exchanges and stuff like that. I think this is the space you want to be, according to ICRA, which ranks all these other flexi caps. I think 40 odd are there in the market today, 40 plus. We are number 3 in that, right? And that performance came not because we are holding a Reliance or an Infosys or a TCS or a Lever or a Nestle, nothing of that sort. It was all depending on our view of the market. In fact, my top 10 holdings were very varied. I mean, there were a couple of small caps in my top 10 holdings, which I don't see normally. You see in other flexi caps.
Dinshaw, Irani, thank you so much for coming back to our channel.
Krish, thanks a ton for having me on your show again.
Rather than talking about investing generally, which we've done in the past, I want to actually focus on one specific product from the Helios stable, which is the Helios Flexi Cap Fund, your flagship fund that you launched, I think, pretty much exactly 2 years ago. My hope with this conversation is that anybody listening not only gets a good sense of how you and the team at Helios think about investing generally, but more importantly, get a very good understanding of what it is they're buying when they invest in this fund. And I should add, just as a disclaimer, that my clients, my family were investors in this fund. So, I mean, to that extent, whatever bias we may have, but just as a sort of form of disclaimer, I want to put that out.
So am I a big investor in my own fund, so no issues. I'm totally biased.
Exactly.
But always good to hear that when you're investing in a fund that the man behind the scenes actually invested as well. But Dinshaw, let's begin with a slightly more macro perspective on the fund and how it's positioned. Now, the good thing of a mutual fund is I don't have to guess what you like. I can just see your monthly fact sheet. But when I look at the holdings of the Flexi Cap Fund today, what should be what does it tell me, the investor, about how Helios is thinking about the market as a whole?
So, okay, Krish, let me go back to the whole concept of why we came up with a Flexi Cap in the first place. So what we realized was that, we were in two minds. Initially, we wanted to rather do a multi-cap or a Flexi Cap. Then we finally took a call only on Flexi Cap because we realized that gives a lot of leeway to the manager to play to his strength. If he likes mid caps, he can be loading up on mid caps without having to worry about a 25% cap and stuff, or rather 25% minimum. If he doesn't like it, he can reduce it below 25. Same was the case with small and mid cap, right? So his preferences work perfect, right? So that was the whole logic. And then we went back and we looked at our fund, the flagship that we've been running, Helios Strategic, the long leg of our fund, and we realized that it was totally a flexi cap. We were very agnostic to market caps, and we were taking calls depending on the view on the market. If the market was looking topish or bearish, we would be going heavy on the large caps, and if it was looking fairly bullish or on a buoyant note, we would top up that particular portfolio mid and small cap, right? So basically, play the beta as you feel the markets are going to move, right? So that's what the whole logic was. And we said, no, we'll go with the flexi. Yeah. Now, what we did realize when we were launching off, we said the actual flexis available in the market were they were mainly 70% large caps, right? And that's it. Probably the flexibility was you want to be 65 large or you want to be 75 large. That was what the flexibility was all about. And we said, look, we can't be this straight-jacketed. We have to be more aggressive in our flexi cap. And you've seen that, right? In our case, we've gone as low as, I think, 47% in the large cap space and as high as probably 70 odd percent in the large cap space. So, and by the way, the timing has been perfect. I mean, if you had looked at our portfolio sometime in October, it was 70% large caps, right? Of last year, I'm talking. And today, it was 46% in September end, and I think October end was close to 50. So that's how it has been. So we've been very flexible in our approach. Secondly, what we did was we said, look, the common holdings across most of these flexi caps were, if you look at the top 10, probably 7 were repeating across, right? We said we don't want to do this. I mean, we don't want to be chasing the index. We don't know. By the way, if you ask me today, what is the composition of the NSE 500 index, I won't even know because we don't, I mean, composition as in the weight of the various sectors within that particular index, because we don't care. We go with our view on the sector. So we take binary calls. If you like the sector, we'll load up on that sector, irrespective of what the weight is there in that index. If we don't like a sector, it'll be zero. So that's what we did here again. I mean, we didn't like IT, so IT was zero. By the way, the performance that you see today, you just mentioned that we've been around for 2 years. So for the last 2 years, according to ICRA, which ranks all these other flexi caps, I think 40 odd are there in the market today, 40 plus. We are number 3 in that, right? And that performance came not because we are holding a Reliance or an Infosys or a TCS or a Lever or a Nestle, nothing of that sort. It was all depending on our view of the market. In fact, my top 10 holdings were very varied. I mean, there were a couple of small caps in my top 10 holdings, which I don't see normally. You see in other flexi caps. And by the way, this is a big one, right? We're talking about a 5,000 crore corpus. We're not talking about a small corpus where I can play around with this money as such. So that's, I think, what gave us that edge across. And I think that's what, and you'll see that. I mean, you will not see us chasing, saying that, oh, look, I don't like IT. So maybe I will, in the weight, say it's like 12-13% in NSE 500. Probably I'll be underweight IT by keeping it at 8-9%. That's not going to happen. If you don't like IT, it's going to be zero. So that way.
Yeah.
And I think that'll keep showing up in our performance as such. So
for anyone watching, in case they're wondering, the fund, depending on which plan, as in whether you bought direct or regular, over these 2 years, I think it's up 24 to 25% compounded for these 2 years. So like you said, I mean, I don't know, maybe I'm sure technically there's somebody who's done better, but broadly speaking, sort of, category leading performance. And let's try and, I want to understand what is it that has led to that performance. And naturally, it's both what you've bought and, just as importantly, what you've stayed away from that's allowed you to do well as a fund. First sector that I want to discuss with you, which I think is quite an important sector at the moment and generally as well, is the auto sector, where you have 4 companies. Now, what is interesting is that, if I'm not mistaken, all your auto sector allocation, as far as the OEMs is concerned, is to 2-wheeler companies. If I'm not mistaken, there's no 4-wheeler company, no truck company, none of that. Can you explain that thought process and why you've stayed away from most of them, but focus on these very specific companies?
So, Krish, if you remember our initial dialogues that we had, we were very clear that we are very negative on the auto space, mainly because of the competition they're going to face from the EV onslaught, right? Which is electric vehicles onslaught. Uh, Same product, but two different platforms, right? And the ICE guys will not even realize what has hit them because ICE is internal combustion engines and EV is electric vehicles, right? The EVs are normally an iPad with four wheels, hardly any moving parts, a couple of scores of moving parts, while you have 2,000 and 3,000 moving parts in the ICE guys. So a lot of servicing required, no servicing required, and there's no after sale service as much as there's need in ICE. So it was a different ball game altogether. And unlike the ICE space, which is controlled in India by probably around four or five major players, EVs was a massive play. Globally, there are 150 odd players. In India, there are again, if the competition is allowed, you'll see a lot of players coming in. But yeah, so that was the whole reason why we were very clear that we will not enter the the auto space. Having said that, the two-wheeler guys, however, what they did manage to do, and they, by the way, they suffered a lot, right? From 18, 19 onwards, all the growth was taken out by EV players. In fact, their market share loss was quite phenomenal for the ICE guys, right? And as a result, they found their way out. They finally did manage to come up with products which are pretty exciting, pretty decent. And anyway, the EV onslaught stopped as such. And obviously, there were a couple of winners within EV, right? So that's what made us look up the two-wheeler space. And then we realized that, look, in the two-wheeler space, with the GST cuts coming in, by the way, so this four stocks weren't there from the beginning. These four stocks came only after August, when the PM announced on 15th of August that there's going to be a rationalization in GST and I'm going to give away Diwali gift. And obviously, what we realized was that one of the long-standing arguments of two-wheeler players are that this is an essential product. You can't be taxing it at 28% GST as such. So we said, okay, this is going to come off, right? In fact, what we didn't build in was that even the cess is going to be taken away. That was a big one. I mean, the cess being taken away from certain engine sizes and stuff like that was a very big one. So anyway, we said, okay, so this has got to come off. Now, sir, let's start looking at the guys which we believe are the future winners, right? So we came up with two names in the ICE space. They were also getting into EVs. They've done a good job in EVs, which is one is Hero and the other one was Bajaj Auto. And then we came up with two EV names, which we felt were going to be good. In fact, the first name that we came up with was Ether Energy. So that we bought at some sub 300 rupees and that phenomenally well, right? And the second name we came up with in EV much later was probably Ola as such. So that's what we did, and I think it's done phenomenally well for us as such. All these four players. You will not see any four-wheel plays or PVs, passenger vehicles, making it to our portfolio. Neither you will see any CV guys because I think even today they are very protected in terms of international competition. Once that comes through, I don't think there's any chance of survival. In fact, one of the data points that I keep sharing with is one of the big EV players in India. I won't take the name. You can open the balance sheet and see it. He spends roughly around, say, $300 or million on R&D annually. He comes up with these 12, 13 platforms in a year for EVs and stuff like that. And you look at a BYD, he spends close to $8 billion on R&D every year, or a Tesla for that matter, which spends close to $5 billion in R&D. Now, where is the competition here, right? I think you're just copying and you're just trying to show it as, by the way, out of that 300 million R&D, 200 million is on capex. So I don't know what R&D is being done on $100 million, but that's how it is. Yeah. So anyway, so we'll leave it here. So we're not too keen on getting into the PV space.
You know, the GST cuts that you mentioned that happened in August, do you think that, and this is again now not focused just on the auto space, but more generally consumption, do you think it signals that the government is now just as focused, if not more focused, on consumption versus, say, investment in the economy?
Yeah. So actually, Krish, if you remember the Feb budget, the first Feb
Hmm.
budget. I think that was the first salvo from the government. They were very clear that, look, I've done enough on the capex
Hmm.
front. I can't do any more. I will keep my capex fixed, but I will give an incentive to consumers. I'll give an incentive to corporates to get jobs in, because ultimately, when you get the jobs in, that's when you get consumption going, right? And so that's what they did from that budget. So when the GST was, I think, uh, in so many, I won't mince around words, but I think it was forced upon us,
Hmm.
because the way the consumption had tanked, and it had tanked from September last year onwards. I mean, if you remember, the September was not September, rather, from the beginning of last calendar year is when you saw a decline in earnings of corporates and stuff like that. And September was the final straw on the back of the camel, I suppose, when we reported negative earnings for that particular quarter. I think that's what drove the government to realize that, look, we have to focus on domestic consumption, because exports can only get you that much. Capex can only get you that much, right? You have to get the internal consumption going. And you've seen that story playing out in China. I mean,
Yeah.
when the consumption really kicked in 2005 and 6, that's when the hockey stick curve took off for their economy as such. And they've done phenomenally well since then. Yeah? So I think domestically also, with a consumer base of 350, 400 million not consumers, though we are a population of literally 1.5 billion, but actual consumer base is 350 to 400 million, give or take a couple of million here and there. I think this is what, uh, and by the way, it's not a small base at all. I mean,
Yeah.
we more than the population of US in terms of consumers, right? Or for
Yeah.
that matter, the whole of EU put together, we more than that, right? So it's a huge base. And I think the government realized that you've got to push this base. And no better time than now, because I mean, if you give me a few more minutes, I'll tell you my views on consumption.
Yeah.
Uh,
Please. Yeah.
so basically, the fact is that if you look at the labor base today in India,
Hmm. Hmm.
fortunately, only 29%, give or take a couple
Okay.
of fractions here and there, composes of pre-millennial
Okay.
labor, okay, pre-millennial.
Hmm.
Why I'm saying pre-millennial, I mean, ones born before 80s, is because we were brought up on a staple diet of don't spend beyond your means, and saving is the right way to go and stuff like that. I don't think you need that in this kind of an environment today. You need to spend, you need to borrow, you need to leverage and stuff like that. And fortunately, the rest of that 71% is either millennials or the Generation Z. I think that is what you need, right? Aggressive spending, and not over leveraging, obviously, but aggressive spending is what you need. And I think this is the way forward for this country per se. And I don't have any doubts that GST is the first uh, form of moving it. And by the way, even in that budget last year, I mean, in Feb, they had upped
Hmm.
the cuts in the taxes, right? From 7 lakhs to 12 lakh slab, they had moved. So that also was a big offer for the consumer as such. And by the way, RBI has done a phenomenal job by increasing liquidity, or cutting interest rates, or making liquidity at affordable prices is what they've done. So I think it's a perfect move.
Another sector where you have, I mean, clearly y'all are happy with that sector is telecom. As is the case with most people who are bullish on this, there's basically two companies they're bullish on, and generally not so keen on the third one. So now, if you ignore the one that's maybe having some troubles, if you look at the two larger companies, is the underlying crux of the matter simply that over the next 5, 10, 15 years, it is inevitable that ARPUs just have to expand? Is that, in a very crude sense, the entire thesis behind that sector?
So I think the fact is that these are the two companies, not two companies, okay, whatever.
Yeah.
Telecom is the
Right.
space which is going to provide you connectivity all through, right?
Hmm.
Be it on just on purely on your voice connectivity, video connectivity, or even IoT, Internet of Things, because ultimately things are going to move that way, right?
Hmm.
Even if you talk about AI,
Hmm.
these guys are the ones who are going to give you that connectivity to the AI bit, right? If you want to talk to your robo, you have to have some way of doing it, right? So that's what's going to happen. Anyway, I'm just extrapolating things. But the fact is that these are the guys in the right place at the right time. In technology wise, I think India is far more advanced than you see in other Western countries. Though we obviously in China is a different ballgame altogether. But the way we've gone about our payment systems and all again aided by telecom, right? The connectivity, which matters. By the way, India consumes, and this is a mind-blowing number, because it's both China and US put together. Uh, the per capita consumption of every single Indian is 37 GB per month, which is like roughly watching probably what, two Hindi movies a day, literally. Slightly more probably. But the fact is that that's a kind of data we consume as a whole, right? So that itself shows you that how adapt we are at such things, right? And obviously ARPU growth has to kick in, because being such huge consumers of data, ultimately you have to pay for it, right? And I think most of the telecom players have realized that, look, this is not, you're not subsidizing for no reason. We've already got the market shares we wanted. From here on, let's live and let live, right? So that's what's going to happen. The third player whom you talked about will survive for some time, but ultimately he has to, I don't know. I mean, some new player has to come in to bail him out, or maybe get merged with the other two. Who knows what the government's intent is? Because ultimately, it's a government company now with 49% ownership, per se. So that way, and that's what's exciting about this sector. And that's why, by the way, if you notice, October was the first month when we bought Reliance, in that particular month, because in their AGM they announced that they're gonna de-merge the telecom business, per se. And I think this is what we are looking for in Reliance, that there's a value unlocking happening. When you do a sum of parts, the telecom business itself was like roughly around two-thirds of the EV of the company at that point in time.
Back to the fund composition, there's, as is sort of inevitably the case, the financial services, if I think of it broadly, is the largest weight in the portfolio. But what I found interesting is when you break down the components, there's two things that I wanted to discuss with you. The first is this idea, and I'm really interested in how you think about this. The idea that if you look at them specifically as investments, forget how they are as companies for a minute, but if you look at them specifically as investments, are PSU banks actually more attractive as investments than private banks at the moment? Just on certain elementary logic of starting valuations, maybe the cleanup has already occurred, so therefore that sort of change is more in the on the public side. But where do you stand on that debate?
So, Krish, our stance of staying away from PSUs is not because of anything else, but the fact that they are not consumer-facing banks. They're more of capex-related banks, right? I mean, they partake in infra spends and stuff like that. Yeah. Our call on BFSI has been purely that consumption will pick up, and obviously you need to get into the space where you believe is going to aid this consumption. So obviously, the NBFCs and the financial services and the wealth managers, or the gatekeepers to wealth, if you call them, the exchanges and stuff like that. I think this is the space you want to be in. And even the banks that we have, private sector mainly, but all these banks, the private sector banks, are more of consumer-facing banks, right? Or for that matter, taking care of working capital of companies and stuff like that. They're not into the fixed asset model of investing into, say, capexes and stuff like that. Yeah. So that is the first thing. The only PSU, by the way, bank that we have is SBI. Public sector bank that we have is SBI. And that's mainly because it's more of a consumer bank than actually a fixed capex kind of a bank, right? So that is why we like SBI. And one more thing about PSUs is that the problem with public sector banks is that the book value looks cheap on the face of it, but you never know what the underlying assets are like. Yeah. So there may be some questions there, or whether they're going to come back or no. So that's why we're very, very conservative in our approach. In fact, even the case of NBFCs, which we picked up initially, we were very clear that the worst of times, which are the ones which really didn't have much of an impact on the book. And that's how we started identifying those names. And COVID was a perfect period to identify those names of who held on to their books, who was the bigger write-offs and stuff like that. So I think that helped a lot in our whole view. So,
is housing finance something that is of particular interest to you?
yeah, Actually, so we have a couple of names there also in housing finance. In fact, more in the affordable housing finance than actually the high-end housing finance, where the ticket sizes are much lower. And our belief is the same here, that when the per capitas move up, normally the consumer, first thing he looks at is a better house, right, rather than a new car. So I think that's where things will go as such. And probably it'll move from there as such, trickle down to the other needs for the consumer. So that's why we are heavy on the housing finance companies.
When it comes to housing, and this is not just housing finance, just housing generally, is it not the case that the better play presumably is actually catering to the very highest end? I mean, I feel like if you try and sell a 1 crore flat, it's hard, but if you want to sell a 100 crore flat, you can't keep it long enough. So I mean, how do you profit, or as a public markets investor, as a fund, how do you position yourself for that?
Yeah, actually, so, the same thing is playing out in the US now, because the high-end houses are being lapped up by the low-end ones are like lying idle as such. Yeah. So it's the same as the case out here. So what we did was we basically went with only one real estate guy. We said, look, this guy's into this high premium homes, and he's in the NCR region, mainly considered in the NCR region. And that's where the real money is, the big money is. So we said, let's go with this guy, right? So, and fortunately, it's worked well because, and by the way, one more thing we saw was the land bank that he had, which areas was he in, has he overpaid for the land banks and stuff like that? And obviously the fact that, well, how are his cash flows? Is he borrowing to get on the, so all that thing we worked out, and we took just one player, we comfortable with that. And that's how we played that portion per se. But as I said, the affordable housing bit is not in tier one cities, right? It's across tier two and three, mainly lower tier two and more of tier three, right? So that's why these housing finance companies that we have are mainly in these segments. You won't find them in a Bombay funding houses or in Delhi funding houses and stuff like that. Be in the smaller towns of Patiala and whatever, Agartala and stuff like that.
Another sector which I think is, I mean, it's in a very interesting sector at the moment for a number of reasons, is power, energy, sort of however you want to think about it. And so you obviously have power companies itself as direct players, but even when I was looking at some of the capital goods companies that you own, they are, indirectly involved in that, entire power value chain. Are you, as a house, taking a call on power consumption driven by AI or anything like that? Or is it just a basic call on supply demand in the economy, and therefore it's a space that generally has seen insufficient investment, and just in that catch up there's an opportunity? How do you look at that space?
So the thing is, AI, I don't think it's going to work out right now. I mean, at least in India, at least it's not going to work out. So anyone taking a bet on AI in India is going to burn his hands, or he's too far into the future as such, even to make sense as of now. So that's out for us. So the utility guys that we own are mainly the guys who supply power, right? That's one. Or those who are funding that capex, right? Second was that. And the third one is, which you mentioned, capital goods. Again, we are in the transmission chain rather than anything else out there, because, and by the way, power, as you know, is a very controlled sector per se. So you have to be very careful of what you pick out there. I think we got only one name in that particular space, in the utility space at least, that supplying. And obviously in the capex bit, as I said, the value chain which is least impacted because of government intervention and stuff like that. I think that's where we are in the transmission space, and that also two big guys who are MNCs, and one of them, in fact, is holding a patent for a particular process which nobody else has. So if you notice that most of the new contracts for transmission goes to that particular company per se. And they've done a phenomenal job. In fact, globally also, they've made it very clear that, look, India is going to be my sourcing base, and I'm going to supply from India, such equipment from India across. In fact, the last reported quarter, they had a massive jump in their exports, and some of them were executing some export projects abroad. So I think that's the space we want to be in. We will not be experimenting too much in this space. I think a very simple space, so let's go with that. So.
I also saw there's companies, you've got those oil and gas companies, you've got some exposure there. From what I understand, historically as a house, you all have bought those more from sort of tactical, purchases rather than necessarily long-term structural plays. But is that still the case, or has your view on that changed?
No, so basically in the oil and gas space, what we did realize was that the government has taken a conscious decision. Earlier they used to use it as a proxy for votes, right? Uh, Cut the prices, make fuel cheaper, bring down inflation, and obviously appeal to the consumer, right? I think what they've realized is that it doesn't make too much of a difference to the consumer. You got to make the prices steady, right? So by the way, last year, the average prices for crude were at $70, right? Today, it's close to $60. Ideally, these guys should have cut off their prices and let the benefits flow to the consumer if the government was involved, right? What this tells you is that the government is now open to the fact that, look, let them enjoy profits, right? Because when the prices move up, they are the ones who are going to bear the costs. So let them have disproportionate profits to take care of the losses as and when that happens. So the call is on crude right now, not on anything else. If crude moves
Right.
up, obviously you will see us selling off our holdings as such. But them earning so much, disproportionate profits is what we like. And secondly, the ones that we own, actually there's only one that we own. That particular company has got a lot of moving parts with it, right? They're looking at de-merging certain parts. But if you look at the sum of parts, it's making a huge amount of sense. Plus the dividend yield and stuff like that. I think it's a very good stock to own.
To what extent do you guys, take a call or at least pay a lot of attention to interest rates? And do you all have a house view on interest rates that colors your opinions in terms of what you buy and sell, or is that something you just stay away from?
No, we do take a very proactive call on interest rates because we sincerely believe that interest rates not only impact the consumer sentiment, but also the way the outside investor is looking at India, right? A rising interest rate scenario is always not too welcome because normally a rising interest rate means your valuations are to be lower to compensate for that hike because your DCFs now become less attractive, right? The discount rates move up. So as a result, your existing the current cash flows become smaller, right? So that is the whole logic there. So that's why we take a fairly proactive view. And obviously, falling interest rates is what we love. And fortunately for us, that is what's panning out now as such. And looking at the inflation, I mean, sub 0.5%. I don't think the country needs that today, right? We need to have some kind of a nominal growth on the GDP front. You've seen what happened in China, right? For the last 3 years, that economy is contracting mainly because they have negative inflation. So I think the RBI is doing a wonderful job in at least getting the money flow going, cutting interest rates, getting the demand back. I think that's what's going to drive inflation going forward. So I have no doubt that even in the December MPC meet, you'll see some cuts happening going forward. So anyway, so we are very clear that this is the way forward for us today. Maybe we'll have some inflationary issues going to the end of next calendar year, but today I think we are home and dry as such.
There's another sector that you and Helios as a house have generally been quite bearish on for quite a while now, which is the IT sector. If there is a downturn in that sector in terms of jobs and employment, that has a very real effect on the economy in terms of a multiplier effect, because these are the people who are starting families, buying houses, buying cars, consuming generally in the economy. And suddenly, I mean, I'm not saying it goes to zero, but if it falls from where it is today, that's a very real problem for everybody, irrespective of what they do. So how do you sort of see that entire part of the picture?
What I believe is going to happen out here is that probably initially there'll be a hiccup, right? Initially there'll be a hiccup because you'll see a lot of layoffs happening in the IT space, per se. Okay, that's why I felt that when consumption kicks in, you'll see a lot of brick and mortar spends happening, right? And this brick and mortar spends can't happen through AI, right? The actual spends happening. I mean, people working there and stuff like that. Yeah. And that's why the government also was very clear that you need the private sector to kick in a big way. If you look at the September numbers, the capex, I mean, I'm talking about the quarter, or rather the first half. Sorry, not the quarter. The first half ended September, because September quarter is a bad comparison because last year was a negative quarter. So that's why all numbers look very exciting. So let's look at first half to first half, right? Now, if you look at the first half numbers, there's a 5% growth in capex by the NSE 500 companies, right? Doesn't look that exciting, but it's on the back of a 1% growth, which happened in the second half of last year. Okay. On that, there's a 5% growth. YOY, there's a 5% growth, but second half was only 1%, right? But that's not the exciting part. If you take out telecom from this equation, because telecom, there were a lot of 5G spends happening into the second half of last year. That was a big capex, right? So if you take off that 5G spends, the capex now stands at 15% for the first half of this year, YOY growth of 15%. Now that is an exciting number, right? So I think the private sector has already realized that, look, you have to now get into this game. They've been holding back capex for roughly around, I think, a year, 2 years or so, 2.5 years before they really started spending now. Probably today it is maintenance capex and green brownfield. But I don't have any doubts with demand coming back into the picture, they'll start showing these greenfield spends. Once that happens, you'll see a lot of employment happening per se. And frankly, I mean, IT, unfortunately, that space is going to suffer. There's no doubt about that. In fact, one of the reports that I was reading, I think it was McKinsey's report. I don't quote me on this, but don't quote me, as in I am not sure which report it was. But the fact was that they were talking about, in the immediate term, 2 million job losses, right? Which I sincerely doubt, because frankly, I mean, the whole base is around 5 or 6 million odd people employed with IT, right? GCC apart. I mean, I'm not talking about GCC right now, right? That's a major employment generator anyways. So 2 million looks like a third of those people getting laid off. I don't think it's going to be such a huge number, probably 10-15%, and not beyond that. And that also will be the base of the pyramid. Unfortunately, the base of the pyramid is entry-level programmers who won't be needed too much. But the fact is that base has to shrink. And if that base shrinks, probably these guys will move into GCCs or something else they'll have to do as such. So they'll have to find alternate employments. And I think the government also has realized, and that's why the incentives came at the time for manufacturing rather than for services sector, because they want manufacturing. But I think the manufacturing contribution today is some 14-15% to the overall GDP contribution. That definitely has to move up for us to be a big player globally. And obviously for the GDP growth to kick in, and obviously to employ the number of people that is needed to be employed going forward. So.
Now, I know you own KPIT, but if I exclude that, there's essentially no allocation to this IT sector. But I mean, obviously nobody actually knows for sure, but at the risk of asking you to gaze into a crystal ball, can you envisage a situation even at any point in the next 2, 3, 5 years also where you would have a meaningful allocation to the sector? Or let me put it in a slightly more blunt way. Do you believe that this is a sector where the best days are firmly in the past?
So my feel is, for till that time, there's a reset in that industry, and that reset has to be fast. I think TCS has seen the writing on the wall, and that's why they're very verbose about laying off people and stuff like that. They're doing a good job on that. By the way, this is not a recommendation to buy TCS. We don't own TCS, right? But I think they've bitten the bullet. So basically, that's what I'm trying to tell you. And the others are still hanging on, hoping things will work out at some point in time. I don't think this is going to work. There has to be layoffs happening, unfortunately. And obviously, the reset will be a very painful one, probably over the next 4-5 quarters. So at least 1 year, maybe we'll be staying away. We'll see whenever the companies come out and say, look, we made a mistake, not made a mistake, but look, this is what we're doing now. And we'll probably take a call then. So at least for a year, I don't think you'll see any entry into IT in our portfolio per se. Maybe smaller players here and there, but not the Okay.
When the fund was first formed, you had maybe 45, 50 positions, and today it's closer to 70. What should my takeaway be from that? Is it that you're seeing more opportunities and therefore more companies you want to own? Or is it a risk mitigation, tool? How or is it just something that changes over time?
So the risk mitigation is always on the top of the mind, right? I mean, it's like basically you want to have enough liquidity in your portfolio to make sure that if there's a big redemption coming, I shouldn't be caught short, right? So that's how it is. But that's not the only criteria. Obviously, you keep adding as and when you see new ideas coming. And fortunately for us, my research team keeps churning out these ideas. By the way, every time we launch a new fund, you see a
Yeah.
few additions happening in my Flexi cap, right? Because what we've realized is that the research guys tend to get a bit lazy. They can tend to get in their comfort zone. That look, I've done so many companies. Okay, let me just keep covering these guys and giving them updates. But the moment you launch say a small cap or a mid cap, you push them to get me more ideas for small caps, more ideas for mid caps. And that's when you see new ideas coming in. I'm really excited with the small cap portfolio that we've developed. And 60 odd stocks will be out soon. I mean, the
Yeah.
November end portfolio will be declared in December, I think 10th or so.
Mm.
But anyway, so you'll see that coming through. And obviously, you'll see some of the ideas flowing into my Flexi cap again. So you'll see some more additions happening out there for. So
Right.
that's how it's gonna work. So Krish, as we mature, we get more names. So that's how it is. And fortunately, the flows are pretty good for us. Touch wood.
AUM has gone up, what, 10x from the launch? I'm talking about the Flexi Cap Fund. Yeah. Yeah, which is, I mean, remarkable. And obviously, it's a combination of both flows plus actual performance. But yeah, no, Dinshaw, this was absolutely fantastic. Like I said, my goal was, it wasn't so much, market kya lagta hai, and, is it going to go up or down? I genuinely want people to see this and know for sure that what is it that they're buying when they buy this fund. And, like I said, that's why it was for this very specific podcast. But thank you so much for coming on. And I hope this becomes a November tradition. And I have you on every year at this time.
You don't have to wait till November, Krish. You can do it anytime. But it's always a pleasure to be on your show. Thank you. Thank you, Krish.